Welcome to our on-demand webinar, all about our much-awaited annual report, The Deal. Every year, we analyse all of the equity investment deals made in the previous year to bring you this comprehensive report. Today, we're going to be doing a deeper dive into the meaning behind the data and what we should expect to see in 2024. I'm Cara McGannon, and I sit in the new business team at Bowhurst, and I'm joined today by Henry and Billa in our research and consultancy team.
Hi, I'm Henry. I'm Managing Director of the Research and Consultancy team.
Hi, I'm Billa Toure. I'm Research Manager on the Research and Consultancy team.
Without further ado, let's get into it. So in 2023, we saw 2,179 deals, but both of the deals announced and the amount invested saw a decline from 2022. So guys, why do you think that is?
Thanks, Cara. So yeah, these numbers are pretty stark. A decline of 42% in the amount invested, a decline of about 25% in the number of deals. How do we make what we're going to talk to you today not just be a gloom fest? Well, I think an important thing is to understand what we've come out of. So these numbers are down on some record highs that we saw in 2021 and 2022. There was a lot of frenzied investment activity that was going to kind of be hard to sustain even in normal times. But what we're actually seeing here in these numbers is, I guess, a couple of different corrections on what happened in 2021 and 2022. From one angle, what we've seen is tourist investors leave the market. So these are investors who came in with huge amounts of firepower, doing very unusual, very large deals in 2021 and 2022. And these really moved the needle on the statistics back then. They've left the market, some because they realized they didn't like or didn't know how to invest in this asset class. A couple have gone bust. So those investors leaving the market has really been able to move the needle on these numbers. So that's why that 42% number is so high. If you look sort of back to the ages ago, all the way back in 2019, in the pre-pandemic period, what you're actually seeing is the investment this year about that. And when we did this kind of talk way back in 2019, we were celebrating those figures. So I think we need to be careful of over exaggerating this as like a small amount. It's still £12 billion to startups and scale up. So there's sort of a lot of investment flowing to these companies. So we've seen that one type of correction from tourist investors. What we're also seeing is something a bit more cyclical, a bit more of a macroeconomic correction as well. So there is a very genuine decline in here, even when you sort of strip out those unusual deals that were in the 2021, 2022 numbers. Broadly, that's been caused by a liquidity crunch, driven by the macroeconomic situation. So interest rates have gone up, which means it's a harder environment to IPO, harder environment to do an M&A deal. That means investors all across the value chain aren't getting their money back, so they're slowing their deployment. So the question, if we wanted to talk about the future, which we will come on to later, is what we think is going to happen with regards to this liquidity crisis.
Okay, and I think the standout moment of 2023 was probably the Silicon Valley Bank collapse. How do you think that affected last year?
Again, another reason for us to actually be fairly optimistic about what happened. I think the outcome of that situation was about as good as it could have been. Now, in the UK, we weren't sort of as exposed. Fewer tech companies banked with Silicon Valley Bank in the UK than obviously in Silicon Valley. So we weren't as exposed, but certainly there was a real systemic risk, particularly more from the fact that so many VC funds banked with Silicon Valley Bank. So the transition over to HSBC Innovation Banking was about as seamless as could have been in the environment, and I think that that's sort of a segue into a wider point about ways in which we can be optimistic. The fact that those VCs kind of managed to stay uninterrupted with their banking, so still have all of their capital ready to deploy. I think a very healthy correction to some of the pessimism that you could have interpreting the numbers on the slide here, is that there's a lot of dry powder in the market. Now, it's a number people talk a lot about, the dry powder that investors have. it needs treating with a pinch of salt. The ability of VCs to draw down on the capital that's been allocated to them differs according to each fund, basically. But certainly there is still some capital out there that's available to be doing deals in 2024. So yeah, lots of reasons for optimism.
Perfect. So broadly speaking, we shouldn't be concerned.
Maybe I wouldn't go quite that far and say, like, I think, you know, we're sort of reaching the bottom of the trough, if you like. I think we've seen the correction. The question is now, are we going to carry on flatlining at this trough, and if so, for how long? I think, yeah, if we think what this means, we're talking about these high level stats. What this means in practice is companies not able to raise finance. They want to raise that finance in order to grow faster in most cases. Some of them, if they don't raise it, they'll go bust. And I think it's the balance between those two things that's at the issue. If it remains hard throughout 2024 to raise finance, then will those companies go bust? They'll certainly grow slower, because that's the whole point of equity investment. So fewer equity deals means more companies growing more slowly. That's a given. It could also mean companies going bust, but that's not a given, because companies have lots of levers they can pull in order to control costs. So they might need to raise because they're burning through a lot of money and would run out of money at a certain point. One solution to that is to raise more finance. But if you can't do that, another one is to cut costs and extend your runway, possibly extending your runway beyond into a point where the business model is profitable. And I think in our data, we can see, so far at least, touch wood, that not too many of these businesses are going bust. It's a difficult point to make, because a record number of businesses are going bust, but actually we have a record number of startups and scale-ups in the UK, more than we ever had before. In fact, with recent research that we did with NatWest, was looking at the fact that there were 900,000 new companies incorporated in the UK last year. That's a record number. Now, some of those are just restructuring. Some of those are companies that are used for, you know, holding property and things like that. But within that number is also a record number of new startups and ventures that will eventually go on to become scale-ups, raise capital, do an exit. So yeah, there isn't actually too much red on the dashboard apart from these numbers we've got up in front of you. So that's why pinch of salt is probably going to be my takeaway phrase for this webinar.
So talking about startups and seeing the number of incorporated businesses last year being so big. And then with that, we also saw the second highest year ever for seed stage deals. What do you think the reason is behind that?
Yeah, so there's still a hefty correction in those seed stage numbers. I guess what's interesting is that it's lagging the venture stage numbers, which saw more of a correction in 2022 than in last year. And as you pointed out, yeah, this is still second highest number on record. I guess I don't want to get too technical, but from some dynamics, startup investing is meant to be a counter-cyclical asset class. The sort of big drops that you're seeing in the growth stage, the fact that we're seeing mega deals go away, is because that's the sort of the end of the asset class that is most exposed to the regular part of the economic cycle, broadly because you need to exit to a corporate or IPO. So interest rates and the macro environment affect your outlook at the growth stage. At the very earliest stage, at the seed stage, although it's the riskiest bit of the asset class, it's the most counter-cyclical, which basically just means if you're looking at that investment, you're thinking about getting your money back 8, 10, norm is getting close to 12 years now in some cases afterwards. So you need to think about what you think the economy is going to look like in 12 years. As bad as things are now, you've got to be a real pessimist to think that that's going to be the same case in 12 years time. So yeah, although it's the riskiest part of the asset class, in a downturn time, it can be the easiest bit to back. And then there's another dynamic as well of some sectoral shifts that we're seeing as well. We'll probably come on to it in more detail, but I think the investment appetite for AI kind of restarts the clock a little bit. You know, everyone is aware that this is a transformational technology. It's like an internet moment. No matter what sort of you're thinking about the rest of your portfolio, you are realizing that this technology is something that you've got to be exposed to. Otherwise, you're going to miss out.
And you mentioned sectors there. So blockchain, for example, has been kind of climbing up the rankings over the past few years. Where do you see the future in that sector?
Yeah, really interesting one, because we've been following it as a sector for years and years now. And when it first had its first peak in the hype cycle, we saw very few deals in the UK. Most of the activity was in Paris, actually, of the activity in Europe. So I think what we're seeing now is just a little bit more legitimacy arriving to the sector. Obviously, blockchain isn't all crypto, but crypto is a part of it. The launch of crypto exchange traded funds and things like that are bringing, I was about to say a veneer of respectability, but actually what I mean is more like a level of diligence on it as a sector. There is much more coverage from older financial institutions on it as a sector, and a lot more appetite for it, therefore, across all sectors. So I think it's having a sort of second peak in its hype cycle, but at a time when the UK market and London financial markets are much more open to it.
Despite witnessing a decline in the clean tech sector in 2023, do you think it should still be an area of interest?
So I do think that the clean tech sector is still an area of interest, primarily due to the urgent global need for sustainable solutions and the UK's government's commitment to addressing net zero and achieving that as well. As we all know, sustainability is becoming increasingly important, and there is a global push to reduce the amount of carbon. And that has actually spurred on the development of advanced technologies within the clean tech sector. The technological advancements that are being seen in the sustainability and the sustainability solutions are more accessible and more cost effective than ever before. And the sector's resilience is actually something that you can see in the top deals of 2023, with Field making it to the top deals. Recent government initiatives as well support this notion, as there has been an accelerated rollout of the electric vehicle charge points and increasing grants for installation. This does support the idea that there is going to be a lot of support within the clean tech sector in the coming years. This doesn't just highlight the government's dedication to the environmental goals, but it also creates a more favourable investment landscape for clean tech businesses.
To add to what Villa was saying, I think it's also an interesting sector in that you've got so many funds that invest specifically in clean tech, or at least sustainability applications. So they're subject to slightly different dynamics. Basically, a lot of those funds set up more recently than, say, your classic B2B SaaS funds. So they're actually at a different point in their cycle, still subject to quite a lot of the same macroeconomic pressures as all other investors. But because they're a bit younger, some of those funds, there's a bit more, some of them have got a bit more capital to deploy.
So obviously this report is looking at equity investment, but talking about the clean tech sector, particularly, grant funding is such an important source of growth in that sector. How do you think that then becomes relevant to the equity investment that follows?
Yeah, so it's really important to bear in mind that most of the companies that we're tracking raising equity use other support mechanisms as well, and in clean tech, grants are such an important source of those, alongside R&D tax credits and all of those other things that can help reduce the cost. I think we're starting to see the sector mature away from them a little bit. So for a long time, when the investment numbers were so low, the sector was almost being propped up by the grant activity. Now a lot of the grant activity is sort of more co-investment and related to scaling up solutions against specific challenges. But yes, certainly the sort of equity numbers that we're showing here are only part of the picture, and grant deals have a huge role to play still.
So kind of given the highs of 2022, followed then by the decline in 2023, how would you say the present market conditions and emergence of generative AI are expected to impact future investment?
So the decline doesn't necessarily mean a decline in interest in AI. Instead, it could represent a broader market conditions, as touched on earlier by Henry, and possibly a shift in investors' priorities or changes in regulations that are actually impacting investor confidence. AI is quite a touchy subject, especially with a lot of governments. So introducing regulations might lead investors to be more cautious, trying to invest into those sorts of businesses. And then touching on the emergence and integration of generative AI, that does signal a promising direction in the sector. The advancement suggests that despite the current financial hesitations, that the value and potential of AI technologies actually remains quite strong. The UK is well positioned to capitalize on these innovations, as, for example, mentioned in the AI Safety Summit, which was held in 2023. It is something that the UK is looking to fund. And the AI sector has the potential to change various other sectors, such as healthcare, finance, manufacturing, all of which align quite well to the UK's interests. So I think in the future, there will be a lot more investment into AI, and there are some promising signals that suggest that also.
So for me, the things that I'm sort of excited about looking out for in 2024 are more the applications of AI. Now, this is in part a shameless plug for a report we recently published on the engineering biology sector. But I think there are so many sort of deep tech, science heavy sectors that are going to benefit from AI in their processes. Drug discovery is quite an obvious one, but other chemical compound discovery and so many more. It's often mentioned that the UK has a really strong science base and is good at doing startups and good at doing spin outs, but maybe we're not as good at doing scale ups. I think AI as a technology potentially has the potential to change that and help us to scale up those solutions.
2023 was an exciting year for Bowhurst. There was the introduction of ESG signals onto the platform. That being said, there was a decline into investments into companies that hit one or more of our ESG signals. That being said, with the government's net zero promise by 2050, could we see more investment into these businesses in the next 10 years?
So the interesting thing when looking at this data, sort of the overlap between investment and our new ESG signals, sort of speaks to some of the difficulty we had in coming up with these ESG signals. As you look at super early stage companies, it can be very hard to get clear information on what their approach to ESG is. And some of these investments are made by investors who have a very strong ESG thesis, and some are made by investors who happen to have backed an idea that they believe in that has a strong ESG rating, if you like. So you see a lot of different things under these investments. Some are those clean tech deals that we mentioned earlier. Some are deals into female founders or all female-led teams. Some are investments into B Corps and companies that have registered with that scheme. So I think it's an area we're going to see a lot more investment. But what's interesting in looking under these numbers is you've got so many different investment theses investing into these companies for a whole variety of different reasons. I guess that's sort of the beauty of startup investing, is that there is so much. When you look under that 729 fundraisings, there are so many different companies with all of these different ESG aspects to their business models.
And speaking of female founders, whilst on a small incline, we are promisingly seeing more and more investment into female founded businesses. Do we have hopes that this trajectory will continue?
The marginal increase that we witnessed in the all-female founded companies in 2023 does actually represent a growing awareness and effort to address gender disparities. Factors that contribute to that increase is the heightened advocacy for gender diversity, and there's more female investors actually entering the venture ecosystem, and a broader recognition for the value and innovation that female-led startups can bring to the UK market and the wider international market as well. In the UK as well, there are a number of accelerators, incubators and mentorship programs that are specifically focused at female entrepreneurs. We touch on this in our Barclays Skills and Hiring report, and that is designed to bridge the funding gap. Additionally, there has been some implementation of policies and initiatives by the UK government and private sectors to promote gender equality. There are many benefits of having a gender diverse team. So some that has been actually measured is financial performance, improved creativity, as well as problem solving. So I do think in the future, we will see more investment into diverse teams, whether that be female founded or underrepresented founders. So people from different backgrounds as well. And this trend can actually be accelerated if the support systems are more widely accessible and easily found by these entrepreneurs.
Yeah, so this is partly down to those tourist investors. Those huge numbers in 2021 and 2022 are the fact that those we've not reached those heights again is because some investors have left the market. Another way of thinking about it, though, is the size of a round is a triangulation between investor appetite for the company, but also what the company needs to do and how it thinks it can spend the money. So from some angles, raising less can just be the most sensible move, especially against this macroeconomic backdrop. So some of this is a decline in investor appetite. Some of it is a decline in investor sort of capacity. So there is just less money to invest. But also it's companies perhaps finding it harder to see how they would spend that amount of money. In that 2021 and 2022 data, there are loads of deals that are sort of for the business model that gets described as capital as moat, where you're raising money and that is kind of the strategy. If you're operating in a space, the most famous one is sort of 15-minute grocery delivery. And so all of that money went in not because there was some great technological solution behind doing 15-minute grocery delivery, but it's because you wanted to outspend your competitor. Those deals don't really happen. Those deals, could call them a 0% interest rate phenomenon. I think also we've just seen some of those. Sometimes it did succeed. The fact that Uber is now turning a profit shows that business model can work. But when was the last time you used one of those 15-minute grocery delivery services? So I think we've seen a different type of equity leave the market, and that's part of what's dictating this graph.
So in the deal, we give a breakdown of the biggest deals of the year. Can you see any trends across some of these businesses?
Yes, certainly. Maybe it's a bit of a truism, but these are all companies that have raised quite a lot of money before. So what you're sort of seeing there is businesses that are proven to some extent or another. These are all businesses now that have proven revenues, proven revenue growth, and probably a clear path to profitability if they're not already there. I think what's interesting in all of our numbers, and if we forget about the sort of recent declines that we've seen, if we look at the sort of astronomic growth in deals between, say, 2011 and 2019, and the amount being invested, back in 2010, 2011, these are deals that if you needed this kind of capital, you would have gone to public markets. So I think it's interesting and cheering that there is still this amount of capital available privately to these businesses. But I think all of these businesses are pretty tried and tested to some extent from investors. Other people call that a flight to quality. That's one of the things people talk about, the deals that are still being done at the moment. Is it just a flight to the quality, the best things getting funded? Yes, that's probably part of it. Yeah, I think a lot of these businesses have proven themselves over the hard yards since we've been tracking them. Many of these businesses from 2011 onwards and even before that.
You mentioned there that some of these deals would have otherwise gone public. Do you think that's a reason why we've seen a drop in IPOs?
Yeah, that's a big factor in what we're seeing. I referred earlier to the sort of liquidity crunch. Some people are saying liquidity crisis. The lack of IPOs is a big part of that. That being said, M&A transactions were always the main route to exit, specifically trade sales. It's about 8 in 10 to 9 in 10 exits are to a trade buyer. So that is very much the common route. But likewise, we've seen those decline as well. So I think if we're going to sort of summarize what we've been talking about as a theme for 2024, liquidity is the issue. And I think I want to end on an optimistic note. So I think although it's an issue, and so everyone is feeling it at the moment, if you're an angel investor with no exits in your portfolio, you are feeling the pinch because of liquidity crisis. If you are a Series A investor, if you are a growth investor, everyone is feeling that kind of pinch. But it only takes some small steps for that to start to relax. And so as much as all of the gears are sort of grinding to a halt at the moment, you only need a few deals, a bit of confidence coming back for the whole thing to start unlock and start seeing that growth trajectory that we saw between 2011 and 2019. And possibly the interest rate cuts that are being mooted could be the sort of catalyst for that. So I think it could be a low level activity in 2024, but once we're in the summer or the other side of it, that's when we might start to see things pick up and potentially pick up quite quickly.
Nice. Well, thanks guys. That's all of my questions for now. But if anyone has any questions, please reach out directly to the deal author Lily via email or drop us a message on LinkedIn. Thanks.
Thank you.
Thank you.